Hello, everyone. Gary Raze of Remax Integrity here for Living in Lane County for your September market update for real estate. So I have my guest again, Mr. Tim Tyler of Supreme Lending, and we'll talk about the real estate and how it's comparing to even last month, and then compared to exactly this time a year ago. And we'll discuss what we think is the future of real estate and interest rates. So just starting off, we'll talk about new listings that are coming onto the market. Right now, we're down about 17% from last month, which is fine, but it's also expected because we're starting into the fall region, and so we expect less market activity at this point in time. Pending sales from a year ago is down 9%, so that's of an interest as well. And of course, we understand why, and it's down only 3% from just a month ago. So things are starting to go a little steeper in that decline. Closed sales were down 25% from a year ago, and we're down 10% just from last month. When I say last month, that's August to September. And of course, we don't have anything about October yet. But we have expected that because that's kind of a natural flow of the market. Inventory. We've picked up a little bit of inventory simply because people are starting to realize that, hey, interest rates continue to climb. We probably ought to get our house on the market as soon as possible to try to eliminate future disaster should it occur. We're at this point in time, we are priced. We thought the prices would decrease, and that's where I need to talk to you a little bit about it. As of a year ago, the median price has only gone down 1%. And the reason for that is because we still have penned up needs for housing. A lot of people still want to purchase. The deciding factor for a lot of people is the fact that I think I'm going to wait because 8% is what it's kind of nearing towards, and that's just too much, when in fact, as I'm going to express a little bit later, that's really just barely above the 30-year average. So we're just not used to that because of the free money that we've been given of late. High employment right now is still happening. We're almost at a full employment situation nationwide, which doesn't help slowing things down. It actually has hurt our inflation rate. It's actually gone up because of the fact that most everyone is working. So it's kind of a good and bad situation. You don't want people out of work, but you also don't want inflation going nuts either. So that's kind of where that's all at. It's taken a little longer to sell a house. It used to be like in 1 month we expected the house to be under contract and actually closing. Now it's 2.5 months. That's the longest it's been for me in the last 4 years. It's taken, in the last 4 years, we have not taken this long to come from the time we first listed a house till the time we sold a house. So that's something that's occurring at this time as well. And Tim, I'm going to pick on you right now because you made the interest rates go up, darn you.
It's my fault, yes.
So tell me, where is it in this early September timeframe? Where is it leaning towards at this moment?
That's very interesting. Like I said in the last time we met, I would have preferred that they would have, raised them at the last meeting, a quarter of a point, because what that triggered was some uncertainty in the markets, and the financial markets act very irrational when there's uncertainty. So they didn't know, when the next hike would be and how high that hike could potentially be. So that sent the financial markets, the bond market, mortgage-backed securities that drive the interest rates.
We kind of expected that to happen in November, and here we are just in the beginning of October, and it seems to have happened again.
Exactly. So at the next meeting, if you're asking me what my thinking is on that and kind of what the consensus is on that, it sounds like they are going to raise a quarter. That's what the consensus is calling for. And then it's going to be kind of a data-dependent wait and see Fed speak.
Yes, Fed speak. Yes.
And but yeah, my personal opinion is that if they were just to stop, I really believe that they're restrictive enough to where there's a lag effect. So all the Fed policy that's been enacted is going to start. You're going to see it.
Slowing things down.
Exactly. You're going to see that in the economic reports.
Okay.
Yeah.
The thing that's the continual risk reward situation. Now I want the audience to think this through. If interest rates are high at, let's say, 8%, should you buy? Well, we know one thing, prices are not coming down. In one whole year, it's only gone down 1%. Okay, so let's think about that. So let's just keep the price right where it's at. Interest rates goes up, you'd think that prices would go down. In fact, it's not. So now, when interest rates go down, unfortunately, more people will come into the market, causing a bigger demand. Bigger demand means higher prices for the house. Do you want to worry about the interest rate, or do you want to worry about the house price? And in my opinion, you're much better worrying about the house price, because the interest rate is the only thing you can change later. If it goes up too high or if it drops down really low, fantastic, we'll just refinance. If it goes up any higher and you've already purchased your house, it doesn't affect you. So in my opinion, and of course I'm always right, always think about the house price, not the interest rate at this point in time, if you want to purchase a home, protect your family, and go on with building wealth. Do you agree or not agree?
I do agree, and there's an old saying: "You marry the home and date the rate." So,
that's a good phrase. So, of course, everybody's got to sit there. So
do the math on that.
Do the math. So anyway, it's not all. It's not as good as we would maybe like it to see the interest rates, but on the other hand, it's still a good time to purchase a home while you can. So that's my little 2 cents worth and your 3 cents worth here in September Market Watch. So we'll see you here next month, and we'll give you the update of how accurate we really are. All right, you take care.